Up to this point, we've classified costs as whether they're product cost or period cost, whether they're direct or indirect costs, which determines where they show up on the financial statements. Now we're going to change course a little bit and start talking about how costs behave. That's going to help us determine how costs will react in the future based on changes in sales or production. So the cost behavior and understanding it is going to really help us to predict future costs. Very exciting stuff. So there's three basic categories of cost behavior: variable costs, fixed costs, and mixed costs. A variable cost is what it sounds like. It's a cost that varies. And a synonym for vary is change. It's a cost that's going to change. So it's a cost that varies or changes in total, in direct proportion to changes in the level of activity. So the variable cost per unit stays the same, but the total variable cost is what varies or changes. An example of this is if you were trying to print a page at UNH and they charge you 10 cents a page. So the variable cost per unit is 10 cents, but then if you print out 10 copies, it costs $1. If you print out 20, it costs $2, and so on. So the total cost of printing changes, and therefore it's a variable cost. Variable costs are going to change based on some type of cost driver. So a cost driver is anything that changes the variable cost. It's what makes the variable cost change. In my example, it was the number of pages we print. In practice, it could be the units we produce, the machine hours that are worked, the miles that we drive, the labor hours that are incurred. It all depends. A fixed cost is one that stays fixed or the same in total, regardless of changes in levels of activity. An example for this would be like factory rent. Factory rent is going to stay the same each month no matter how many units we produce in the factory. But fixed cost expressed on a per unit basis is going to change. And it changes inversely with changes in activity. What the hell does that mean? Well, let's think we're going to an all-you-can-eat buffet. So you go to an all-you-can-eat buffet, you pay $10 to get in. That's a fixed cost. No matter how much you eat, the $10 total cost is not going to change. But then what happens? Well, if you're like me and you go to the all-you-can-eat buffet, you better wear your stretch pants because you're going to eat a lot. Why do you eat a lot? Because you're trying to take the cost per bite and make it as low as possible. So this is what the fixed cost per unit is going to look like. This is dollars and this is quantity. The more I eat, the lower my cost per bite becomes. So though the rent of my factory might be a constant amount in total for the month, the more units I make, the more I'm able to spread that cost over those units, thus reducing the fixed cost on a per unit basis. Another way to look at it is to think of like peanut butter on a toast. If you have a finite amount of peanut butter, like 1 tablespoon, you put it on 1 toast, you got some good peanut butter action going on. You take that same 1 tablespoon and you put it over 5 toasts, well, now you got a very, very thin layer of peanut butter on each toast. The amount of peanut butter per toast goes down as the number of toasts are increasing. There's 2 different types of fixed costs, committed and discretionary. So committed fixed costs mean in the long term, we cannot get rid of those costs. It doesn't mean forever. So in class, I usually joke around and talk about a committed cost being like a committed marriage. A committed marriage should last forever. I hope mine does. Love my wife, but it may not. Y'all know that 50% of marriages end in divorce. And if you didn't know, well, I just burst your bubble. Sorry. But ultimately, a marriage you're supposed to be committed in, but you may drift apart and you may end up getting divorced. But it's not easy. You can't just text somebody and say, we're divorced. There's a big process you need to go through. So a committed fixed cost is one that in the short term you can't get rid of, but in the long term you can. So like property taxes would be a committed fixed cost because you can't get rid of the property tax unless you get rid of the factory. You can't get rid of the factory in the short term because you're not going to be able to make the product anymore. So I just want you to understand that committed doesn't mean forever. And if you think that, you're never going to come up with the right answer. So in the short term, we're stuck with it. It's a committed cost. A discretionary cost would be like your girlfriend or boyfriend. Now, I'm not promoting this, but you could just send a little text, say it's over, and boom, it's done. On to the next. It's very easy to get rid of it in the short term. Again, I'm joking around. I'm not promoting that you break up with your boyfriend or girlfriend over text. But a discretionary fixed cost is one you can get rid of very quickly and easily. Advertising costs, training costs would be some examples where you can just decide not to do it. No harm, no foul. Boom, it's over. So you need to understand the difference between the two because as a manager, I'm trying to make decisions. Committed fixed costs I have no control over. I can't change them. So there's no point in looking at them. I don't need to whine about it. There's nothing I can do. Discretionary, on the other hand, those are the costs I want to focus on because in the short term, I can modify and change those. Whenever we're talking about cost behavior, our assumption is there's a certain relevant range in which the rules that we just discussed will actually work. So economists say that costs are like a curvilinear function, which means they go up substantially at the beginning and then they kind of get consistent and then they kind of change again later on. So the relevant range we're dealing with is the point at which all of the rules we just talked about for cost behavior work. So you could see that even though it's curvy, basically in that relevant range, a straight line can predict the cost. So fixed costs are only fixed within the relevant range. Well, what does that mean? It means that, if you have office space and you're renting it for $30,000 a year in increments of 1,000 square feet, your cost for rent is going to stay the same at $30,000 until you need to increase your footprint. If you need to expand your office, you're going to have to add another 1,000 square feet, and that's going to make your rent jump. So the same is true with like a manufacturing facility. Our rent for our manufacturing plant is going to be fixed or constant. But at some point, we can't make any more units. We reach capacity. We're going to have to expand, which at that point, we're going to jump and our rent or our depreciation for the factory, if we purchased it, is going to change. So the relevant range is the range of activity in which it won't change. So if we can make 100,000 units in our factory, the relevant range would be 0 to 100,000 units. Outside of that, the rules won't work. So you could see the relevant range here is the range of activity where the fixed cost stays constant. It does jump periodically once we get outside that relevant range because we're renting more space, so we have a higher rent amount in total. But then once you go from 30,000 for 1,000 square feet up to 60,000 for the 2,000 square feet, it stays constant within that new relevant range until you jump again. So the relevant range is going to be the range of activity that we utilize whenever we're talking about cost behavior, because it's the range in which the rules that we went over will work. So here's kind of a summary of variable and fixed costs and how they behave. I'm going to create my own additions to this summary. So variable costs in total are going to change, and fixed costs in total stay the same. So the name of the cost tells you what happens in total. So variable, vary in total, fixed, stay fixed, or the same in total. When variable costs change, there's a direct relationship. So as quantity goes up, variable cost in total is going to go up. Likewise, as quantity goes down, variable cost in total goes down. Fixed costs in total stay the same, so they don't do anything. They don't move. Okay, and I think pictures are nice. So here's a picture of a variable cost. It's going to change in direct proportion to changes in quantity. So that's dollars. This is quantity. And then our fixed cost in total is going to look like this, just a flat line. Doesn't change within the relevant range. Then everything flips when we're talking on a per unit basis. So variable cost change in total. So what's the opposite on a per unit? They'll stay the same. So the picture is going to look like a flat line, like the fixed cost. So the example I gave was like the cost to print at UNH being 10 cents a page. So that doesn't change. It stays the same on a per unit basis. 10 cent, 10 cent, 10 cent. And then fixed costs stay the same in total. So what's the opposite of that? Well, on a per unit basis, they change, and the relationship is inverse. So as quantity goes up, the fixed cost per unit is going to go down. And as quantity goes down, the fixed cost per unit goes up. Remember our all-you-can-eat buffet? Our all-you-can-eat buffet, the more I eat, quantity go up, the lower my cost per bite. The less I eat, quantity go down, the more I pay for a bite. And then the picture of that, remember, looked like this. It starts going down real fast and then kind of levels off. So let's do a little quick check. Which of the following costs would be variable with respect to the number of ice cream cones sold? We got to know what our driver is. So the ice cream cones is the driver. So take a minute, pause the video, and identify each one of these items as either fixed or variable with respect to the number of ice cream cones sold. All right, welcome back. Let's take a look. So the cost of lighting the store, that's going to be the same no matter how many ice cream cones we sold. So it's a fixed cost. It's not going to change based on how many ice cream cones we sell. The wages of the store manager, again, that's going to be fixed. It's not going to change based on how many ice cream cones we sell. The cost of ice cream, that would be variable because the more ice cream we sell, the overall total cost of ice cream is going to change. And then if you ever got ice cream, you know they wrap a little napkin around the cone. So the cost of napkins for customers, that's going to be variable because the more ice cream we sell, the more napkins that are going to be used. It's important to consider the cost driver because the answer can change. So, for instance, the wages of a store manager could be variable if the cost driver was the number of stores, because the more stores we have, the more store managers we would have. Likewise, the lighting of the store would be variable if we were talking about the number of stores that we had. So the more stores we have, the more lighting costs we would incur. So it's important you pay attention to the cost driver in order to identify whether something is a fixed or variable cost. Let's see if I got these right. Yes, indeed, C and D are our variable costs for the reasons we just discussed. Let's talk about mixed costs. Mixed costs are the baby of fixed and variable. They have a little bit of both. So mom and dad get together, they have a baby. The baby usually looks a little bit like mom, a little bit like dad, hopefully not like the milkman or anything. But ultimately, the baby has a little bit of both. And that's what a mixed cost does. So the mixed cost has your fixed cost piece, which is what you see right here. This is the fixed cost component. And then the variable cost component is this line up here. And then because the variable cost component's added to the fixed cost component, that's considered a mixed cost because it has both fixed and variable pieces. A variable cost would generally start right down here at 0, but because we have a fixed cost, even when we sell 0, we still incur our fixed cost, and then our variable cost gets added in. So the slope of this line would represent the variable cost per unit. And then this intercept, the y-intercept, oh my God, flashback to junior high or middle school, that is going to be our fixed cost. So we can actually create a formula for this. You may remember the formula y equals mx plus b when you learned it. The book here used y equals a plus bx. I don't like either one. I like to use y equals vx plus f, because the letters kind of help me determine what the hell I'm dealing with. So I'm going to change this down here where f is the total fixed cost and v is the total variable cost per unit, and then x is the level of activity and y is the total mixed cost. So I like the formula y equals vx plus f because it helps me remember what the variables stand for. And then we can use that cost formula to then predict cost at various levels of activity. So we have our mixed cost, y equals, I'm going to again change it, y equals f plus vx to keep in the order that the textbook presents it. And it says we have a utility bill and the monthly charge is 40, and then we pay on top of that 3 cents a kilowatt hour. And we want to know what would our utility bill be if we use 2,000 kilowatt hours. So in order to get the answer, we're going to start with our fixed cost, which is the 40 bucks, and then we're going to add our variable. And our variable is going to be the variable cost per unit of 3 cents times the number of units, in this case kilowatt hours. So our total variable cost is going to come out to be $60 if you do the math, and then add that to the fixed of 40, and you get your total mixed cost equal to 100. Before we wrap up the discussion, I just wanted to take a second to kind of give you an overall summary of what you should have learned. So there's different types of costs. There are variable cost, fixed cost, and mixed cost. And then they behave differently in total and on a per unit basis. So create this chart. Variable cost and total are going to change as quantity goes up. Total variable costs go up as quantity goes down. Total variable costs go down. And it's going to look like this in a chart format. Fixed cost and total stay the same. So they look like a flat line. No matter the activity, the total fixed cost stays the same. Then on a per unit basis, they flip. So variable change in total. So on a per unit, they stay the same, which means they now look like that fixed cost line. Fixed cost and total stay the same. So the opposite of that on a per unit means they change, and the relationship is inverse. So as quantity go up, fixed costs per unit goes down. As quantity goes down, fixed costs per unit goes up. And again, that looks like this. And now we add mixed costs to this table, and mixed costs are a little bit of mommy and daddy. So mixed costs always follow the item that changes, because when you add something that changes to something that stays the same, the total is still going to change. So mixed costs and total are going to change just like variable costs. So quantity go up, total mixed costs go up, quantity go down, total mixed costs are going to go down. And it's going to look like the variable cost line, except start a little higher because it starts at the fixed cost level. And then on a per unit basis, again, it follows the item that changes. So it changes like fixed costs do on a per unit basis. So as quantity go up, the mixed cost per unit is going to go down. As quantity go down, the mixed cost per unit is going to go up. And the picture is going to look similar to the fixed cost per unit. So hopefully this will be a nice summary that can help you identify cost behavior appropriately and any problems that you may face in the future.